everyone. Welcome to the Modern Wealth Management Educational Series. My name is Kyle James. I have Marty James. We are managing directors in the Indianapolis office, and we are here to talk about year-end tax planning for 2025. So we just had the passage of the One Big Beautiful Bill. Some people are calling it ABBA. Some of us calling it the OB3 for the Star Wars fans. Marty, where do you think that you land on that?
That's a good question. I've been going with the OBA.
OBA? Yeah, I'm more of a Star Wars fan, so I think I'm going to stick with the OB3. So, but yeah, diving into it here, one of the big things is the tax rates have been permanently extended. So Marty, why don't you kind of dive in to talk about what that means, kind of the planning aspects around that.
Yeah. So when they say permanent, that's probably not true. It's because since 1913, tax rates have never been permanent every time they've made it permanent. So we can expect changes in the future, but we do have a window of time here. So, prior to the July 4th bill, we were kind of racing to the end of 2025, taking advantage of the lower tax brackets. Now we have, more time. We just don't know how much more time. So I don't think our thought process has changed a lot as to, planning for it, because the reasons you're doing like Roth conversions is because one is the fear of, tax rates being higher in the future, which I can't say they're going to be, but my gut tells me they could be. And it's the other thing is on the Roth conversions, life, happens. And it's good to have that pool of money that, say, hey, I just had a client this last week, had to put in a new heating and air conditioning system, about $20,000. Well, we'd already planned for this. So he has money sitting in the Roth. And so we can actually take the money out of the Roth, no tax impact. We're not going to blow up his tax bracket, create more IRMA charges and such. So you have to really think, far out in advance, not just focus on the taxes, but what could happen in life.
Sure. Yep. All good points there. So along with the permanent extension of the rates here, there was a couple of things that kind of really stood out was the new senior tax deduction. I believe it's for those folks that were 65 and older, get an extra deduction in addition to the standard deduction. Kind of talk a little bit about that.
Yeah. So this was, part of the campaign promise where, no tax on Social Security. Well, they couldn't really do that. So they just made it an additional senior deduction. And so if you're over 65, you get $6,000. And if your wife's over, 65 or 65 or over, there's another $6,000. So that could be, $12,000 on a married filing joint tax return. The issue though is also that phases out, so you have a married couple and their income hits 150,000, that 12,000 starts being reduced and eventually, it could completely go away. So it's something you've got to be aware of. And that's not permanent either. That, I think that it ends at the end of 2028.
Mm-hmm. Yep. So 28 or 29. 2028. Agreed.
Yep. Yeah. So it's not a permanent, deduction at all.
Mm-hmm. Yep. Exactly. So then along with the senior tax deduction, I know the charitable donations is something that will impact quite a few folks out there. Quite a few changes to how those deductions can be taken, not only for your itemizers, but for your non-itemizers as well, excuse me. So go ahead and kind of talk about that.
Yeah. So for 2025, nothing's changing with charitable contributions, but 2026 it does. So that really impacts your planning for 2026, because in 2025, in 2026, what happens is we lose the first 0.5% of our charitable contributions. So it's kind of like your medical deductions where you have to get over 7.5% of your adjusted gross to get any of it as an itemized deduction. Same thing is not going to happen with your charitable contributions. You're going to take a haircut of the 0.5% of whatever your modified adjusted gross or your adjusted gross is for in 2026.
Hmm.
In 2025, we don't have to worry about that. So one of the things we're recommending is people not only look at their 25 but they're also looking at their 26, tax return, what that's going to look like. And for some people, stacking these deductions in 2025 will make a lot of sense, simply because you're not going to lose that 0.5%. The other thing is with the higher standard deductions, say I'm really, really close and uh, to going over that standard deduction, which is 31,500 for married couples, before, assuming they're not over 65, we get additional amount, there. Um, but if I'm really close, then maybe I want to stack those charitable contributions into 2025, push over that limit, and then the next year take the standard deduction.
Hmm.
Uh,
So when you say stack those donations, like what exactly does that mean? How would you
yeah,
do that?
I'm going to pull forward my charitable contributions into 2025 that I might be making in 2026, and I may even pull 2027 depending on what my goals are. And a lot of it depends on age. Because and the way a lot of people do this is using what's called a donor advised fund. It's called a DAF, is what we refer to it as. So I put the money in, which I can also do, appreciated securities, long term securities, and things like that in there also, and create this charitable contribution that impacts the year that I do that. Now, when I pay it out, I do not get an charitable deduction, but I'm taking the standard deduction I'm kind of double dipping on this. But I want to always uh, bear in mind how close I am to 70 and a half when I can do the holy grail of charitable contributions, and that's through my IRA with the qualified charitable distributions. So maybe I load up enough to bridge me to that, and then 70 and a half, I start attacking my IRA and giving that directly to my charities.
All right. So what's the rule on the amount of I can deduct as it relates to my adjusted gross income
Yeah.
from a donation
Yeah.
standpoint?
So like cash contributions, checks, and credit cards, that's up to 60% of my adjusted gross. Now, when I do appreciated securities, when that could be like mutual funds and ETFs as well as individual stocks, that's subject to 30% of my adjusted gross. But if I can't use it all in that year, it'll carry forward for 5 years before it's gone. Uh, so one thing I would caution people, if they have mutual funds that they're going to do this with and they've been reinvesting dividends, uh, some of those dividends are not long term yet. So you're going to want to take those lots that are long term and drop those into like the donor advised fund or use that for my contribution.
Hmm. Yep, good points. Um, let's skip to another big change is the state and local tax deduction. I know there's been some increases in that, but there are some AGI limitations. What exactly do we need to be watching out for there?
Yeah. So before, well, the Tax Cuts and Jobs Act, they cut our state and local income tax deduction to a maximum of $10,000. So, somebody could have had, $40,000 of state and local income taxes, but could only deduct 10,000. Now that same married couple could potentially deduct, $40,000. However, once we hit 500,000 of adjusted gross, that starts phasing it down until I hit 600. And when I hit 600, now I'm down to that $10,000 limit. So that tax rate effective or the marginal dollars on that as I'm crossing for that through that $100,000, is extremely high. So you really want to, pay attention to that.
Mm. Okay. And then as far as any changes to like if you don't qualify or you don't have enough deductions to itemize, was there any increase in the standard deductions that we need to be aware of that could impact anything?
Yeah, yeah. So your standard deductions for single people is 15,750, and for married couple, it's 31,500. We still get the additional senior deduction of, uh, or age 65 deduction of 1,600 per couple, per person. So it's like an extra 3,200, and then we still have the one for being blind also.
Mm-hmm. And then so additionally, I believe the talking about or switching to estate and gift taxes. those limits have been extended too, and then increased slightly. So we don't necessarily need to worry about those resetting. Is that correct?
Yeah, at this point, we're looking at we've got a $15 million lifetime exemption for estate and gift tax, and that's per person. So if you have a married couple, we're $30 million. The risk is that, let's say, a spouse dies and I don't capture their 15 million. There's a thing called portability, and then let's say several years from now they drop it down to 3.5 million, and that now that could be subject to estate taxes, where if I do the portability, I capture that 15 million. Then if they drop it down to 3.5 million, so I've got my 3.5 million plus the 15 million that I captured, so I can be safe. The key thing to be aware of is when a spouse dies, there needs to be a discussion of that portability. Had a situation recently where they actually funded a credit shelter trust, but the attorney and the CPA did not file for portability, because the client would really like to be able to get rid of the credit shelter trust, to get the step up in basis, for the beneficiaries. But the risk is, even though he personally is underneath the 15 million, the risk is by the time he would pass away, they actually drop that. So we're kind of stuck there. We're so really in the whole estate tax area. For most people, it's still an income tax game when somebody passes away. We're looking for step up in basis. And then, for some people, we are wanting to get that growth out of their estate. And that's where you would use like the bypass or credit shelter type trust.
Okay. So with all these changes, some happening 2026, some being permanent, does it still make sense to do a Roth conversion? Or what would maybe trigger me to do that? And maybe how much would I do? What would make sense there?
Yeah. So this is where, the financial plan comes into play. And then that's where we overlay, the long-term tax plan inside that. So if we see ourselves being pushed into a higher bracket because of our required minimum distributions, which are going to start at age 73 or 75, depending on or if I've already started, then that would be a trigger for me to want to do the Roth conversions. The other thing is again, the lifestyle thing. If I am doing like the bracket bumping strategy, where I would say I'm in the 12% bracket, right now, I want to be sure I use all that. And create that pool of tax-free money, so when life happens, I do have money to get in without paying higher taxes in the future. Right now, there's a lot of YouTube videos and people out there, debunking, no, RMDs are not a problem. You shouldn't do Roth conversions for most people. Well, they're really taking a very myopic view of this and assuming everything is static. And we all know that, number one, tax law is not static. Number two, lifestyle, life happens, and they don't factor this in their analysis.
Good. Yep. Completely agree with that. And then one final thing, I had heard that the IRS is no longer issuing paper checks.
Oh,
Can you confirm or deny this,
yeah,
or
that
how that's going to impact people?
that was an executive order. Yeah, so it's got to go directly into your bank account, and eventually it'll be such that you won't even be able to send them a check. But I can't imagine how this is going to work as far as not issuing paper checks and they give you a debit card instead. Yeah. So all this remains to be seen, but yeah, so far that's what's happening.
Understand. Well, Marty, I appreciate the time today. This has been the educational series on year-end tax planning, and we will see you guys on the next one. And so with all these changes with the OB3, or the One Big Beautiful Bill, it's important to get with your advisor, your CPAs, and here at Modern Wealth, we have all those under one roof here with all of our advantage offerings. So please reach out to us to help you kind of navigate any questions you may have. And if you like this video, please like, share, and subscribe.
The views expressed represent the opinion of Modern Wealth Management, LLC, an SEC-registered investment advisor. Information provided is for illustrative purposes only and does not constitute investment tax or legal advice. Modern Wealth Management does not accept any liability for the use of the information discussed. Consult with a qualified financial, legal, or tax professional prior to taking any action.